Welcome to the Corner Office, where we bring you the latest news from the world of commercial real estate, the greatest voices in the industry, and the corporate chats you've been missing. Let's get to it.
Hello and welcome to the Financial Bunny TV. My name is Nicolette Mashile and I'm also known as the Financial Bunny. Today is going to be a very interesting conversation. I know we always talk about investing in property, investing in real estate, and for a majority of us, our gateway into it is always residential property. We talk about buying for rental, and that's about where most of us want to stop. But there's a whole world out there of commercial property, and today I get the opportunity to speak to Jonathan Jack, who's the CEO of Galetti Corporate Real Estate, and he's going to take us a little bit into what are some of the opportunities that do exist within corporate or commercial property rather. Now, do you remember none of my videos constitute as financial advice? However, if you are looking for financial advice, please do speak to somebody who is certified and registered with the FSCA. John, welcome to Financial Bunny TV.
I knew I shouldn't have told you my name was Jonathan. I knew it. I knew off the bat. I was like, that's what's going to happen. He's going to call me Jonathan now.
But that's your name, sir.
Yeah.
That's your home affairs name, isn't it?
It's my home affairs name. I think I'm going to change it.
Absolutely.
I'm going to change it.
Why?
Legally. I'm going to legally change it to John, and then I can officially know that I'm John.
Oh, we sympathize with
Yeah,
you.
thanks.
Can I tell you something though? I get asked all the time, what's your African name? And then I stand there and I'm like, it's Nicolette. I don't know what else to say because
Tough.
I mean,
crowd.
I wasn't there when my parents were naming me. So
Tough
like,
crowd,
how do
yeah.
I answer that?
Yeah.
Can I tell you what my full names are?
Yeah.
And I guess
No.
it's Nicolette Nadia Mashile.
Nice.
Right? Okay, John. I'm going to call you John from now on. Right, guys? Now, please note if I say John, I am referring to Jonathan Jack. Let's talk a little bit about property. I mean, I think for a majority of people, we've been sold that property is this Hail Mary asset that one can invest in and you can become a real estate billionaire. Is it really all that we hear about it?
You know, this market's had a phenomenal run. I mean, literally, I think we went from really, really high interest rates at the end of 98, where, you know, basically what happens is yields or your returns on property track the interest rates largely. I mean, not identically, but they track the interest rate. So if your risk-free money is sitting at 15%, so let's say the bank, you put your money in the bank and they would give you 15%, then why would you buy a property that's going to give you 10%? So it loosely tracks those interest rates or your risk-free rate, your long bond rate, you know, the government 10-year bonds type of thing, right? So in 98, the interest rates just went ballistic. They went really, really high. And so yields obviously tracked those up. And then what happened is you had a whole new market, you know, post 94, now you've got a whole new market. Money's coming into the economy. The middle class is growing significantly. And so there's more spend. And so businesses are growing. GDP growth is fantastic. And GDP growth is really what drives property prices at the same time, or growth in the capital value of properties at the same time, right?
Okay.
So going into the early 2000s, you just have property values going up 30% year on year. Now, property is also something that you borrow money on. So if you buy R1 million property, in residential, you typically go and put in 10%. In commercial, you're going to put in 30%. And so ultimately what happens is if you have a 30% growth on your property, you have a 30% growth on your cash, which is only 30%. So you've got 100% growth on your money. And this was just happening year after year. So people were making ridiculous money in those early 2000 period.
Yes.
And that run pretty much besides for 2008 where it dropped off again, it started to build up and it ran all the way to sort of 2018. So people have made fortunes. Yeah. And in the early days, banks were also giving you 100%. So you didn't even have to put cash in. You were making money for nothing. So that was the market.
But 2008 was because of property.
It was, yeah.
Yeah.
It was a lot of risky capital in the market, just free money. You know, we've seen a similar thing now, right?
Yeah.
Which is why you had your crypto stock. So basically the cost of borrowing money was next to nothing around the world. So people would just borrow money and put it into risky assets. But you've seen all the cryptos crash and you've seen a lot of those more speculative assets crash, you know, your tech stocks, that kind of thing. They've fallen right off because there's interest rates are climbing around the world because of all of the inflation that they're trying to stop. And ultimately what's happening is people are taking their money out of risky assets. You've probably seen a lot of where the guy's got the Porsche and the second car and the third car. You've seen a couple of those getting sold as
Yeah,
well,
yeah.
so
People are going back to what they know and what they...
getting hold of their cash.
Yeah, true. And I guess when I started the conversation, one of the things I mentioned is the fact that a majority of us, when we talk about investing in real estate, or let's break it down to in property, we'll come to your real estate stocks and all of that. When you talk about investing in property, a general amount of people will go towards residential property.
Sure.
Why do you think that? Is it an information thing? Is it a not knowing access, or it's a money thing?
Money,
as
cash.
he gestured, money.
Yeah,
Okay.
cash available. So, look, the reality in this thing is, in residential property, it's probably 10% down. So the bank is going to give you, largely, the bank's going to give you 90%, and you have to put in 10%. You can also go buy a R1 million property, 2 million rand property, even less. You can buy in the 500,000, 600,000 rand. You've got to put in 10%. That's achievable, for the middle class, etc., and upward. That's achievable money. You can go and find 60,000 rand, 100,000 rand, etc., and buy it. Put a 10 and 10, and you start your property portfolio. Commercial property is different. They require 30%, and they only fund 70%. Okay. So now you've got to come up with 30% of the value. Bigger number, 3 times bigger.
Yeah.
And secondly, the bank will only fund the property over 10 years, not 20 years.
Oh.
Okay. So your repayments on residential property are lower because it's funded over a longer time.
Absolutely.
And on commercial property, higher. So typically what you'll see a higher return on commercial property. Okay. So residential property, you'll see these 6-7% returns. That's because you have stretched your borrowing out over a longer period, so people can actually just make it work.
Yeah.
And you typically, in good areas, get a nice capital growth. So that's the story in residential property. Commercial property is just different. You've really got to look at the underlying tenant. Those tenants are going to be in there for a year, 3 years, 5 years, 7 years, 10 years. And obviously the longer that tenant's in there, the better for you. You don't have vacancy, et cetera, et cetera. So there's so many things that come together when you're looking at a commercial property. But the big thing is, why is it hard to enter the market? Cash.
It's a cash issue. And I'm just thinking also the reliability of the tenants that you're going to get, as you said,
Critical.
It's very critical. Even in residential property, you get some very unscrupulous characters, renting out. So I can imagine it's even worse when it comes to commercial property, considering the fact that some businesses just don't make it,
It's the hard thing about commercial property because you got to look at that. We call it a covenant. So what is the covenant is the strength of the tenant. So what is the strength of your covenant? And basically it sits at that risk-free rate, right? So let's say the government is borrowing money at 10%. They'll pay you 10%. They'll borrow your money. They raise a bond.
Yes.
And so effectively that's your risk-free because technically the sovereign has the highest credit rating. Yeah. Technically. So you have this high credit rating of the sovereign, right?
Yes.
That is just risk-free money for you. So as an investment, that's the risk-free rate. So what happens after that is, depending on looking 10 years ahead, how much vacancy are you going to see in your property? How much maintenance are you going to have to do in your property? How specialized in your property is your property, and how likely are you to replace that tenant should yours default? So if you had a 10-year lease with a bank, that's fantastic. You're not expecting ABSA to default, and you got 10 years of income, so you don't apply a lot of risk on top of the risk-free rate, right? However, if you've got a short-term lease, your tenant might not renew, which means you're going to have a vacancy period. Who you're going to replace it with? Or if you have a poor tenant, which means they might default. Even if it is a 10-year lease, and it's not such a great tenant, you're going to add some risk. So that's how people largely determine what the yield is on property. You have people saying, what yield is that property on? Commercial property, it's all about the yield. People value the property on the yield.
Yes.
And basically what they're trying to say is they're trying to adjust for risk. So at the moment, a prime property, Cat A, great property, new, doesn't need a lot of maintenance, and it's got a great tenant, and you're probably paying 9%, in the 9% range, 9.25%, 9.5%, etc.
Yes.
Return-wise. And then going from there, you just add risk. So if you've got a poor tenant in not such a great area,
add on to the 9.
12, 13, 14%. And so you get a higher return based on the fact that there's a little bit more risk in that one.
Yeah, it sounds like how the banks give you credits. So you've got 100%. The unsecured and the secured credit. Correct. So basically, if they see that you're a bit of a risky person, they'll obviously bump up how much they charge you.
They're going to give you better terms if you're buying a 10-year lease with the bank than buying this thing with a 3-year lease. They're going to give you better terms. So it's exactly the same thing. Yeah.
Let's go back to that halo conversation. Money. So where does one find money then to invest in commercial property? What are the options that are available out there?
Yeah. Listen, you piqued my interest the other day when you were talking about Stokvels, because obviously that's pretty much the most untapped market in the country. And largely that money is never invested that well. You know, sometimes there are like larger Stokvel groups and they have some kind of asset management around it. But property is just one of those assets that has a very low risk rating, you know. So my advice would be to get into that market, have almost like an asset manager that really understands where that money's going and what they're investing in, and then invest that money and don't gear it up as much. You know, reduce the risk on that property. So typically, like I said, you can gear up to 70%.
Yeah.
Don't.
You don't have to.
Gear to 50% or gear to 40% or whatever it is. Act like the listed funds do. You know, the listed funds will only gear to 40%. So do that. Use some gearing, because the gearing, and I'll explain the thinking behind gearing, but it's such a low risk return, especially in this market where we've had every single supply shock, every single shock that you can have. We've got high inflation, we've got a war in the Ukraine, we've just had 2 years of pandemic. It's the worst that it can be. So you're going to start finding some of the best opportunities in the market at the moment. Take that Stokvel, invest it into a property, and then you have a growth asset with stable income, stable returns. It's such a great market. So that putting together is a good opportunity. The other thing is the entrepreneur that runs their own business, they should be looking for the property to buy to run their business out of.
So not renting warehouses and all of that stuff. Yeah.
To them, it might, for the business or for, from the outsider, they might say, okay, well, this is not a bank. It's a business that's operating. So how do we finance that? Or, is that a building that we want to buy? But for the operator, it's much lower risk for them, because that business is intrinsically attached to them. And they understand the risk profile of that business. They can go and buy their own building and then pay themselves rental effectively. Always better to put in two different entities, have your propco and have your opco, and separate the two, because then you can sell.
Sorry, hold on. You're speaking too fast. Propco, opco, so property company.
Property company.
Okay, and your operational
company.
So your actual company.
So I mean, really, business or commercial property is always bought in a PTY or a trust, or it's never bought by the individual.
Okay,
because typically there are VAT implications to it, etc.
Yes.
So you house it in its own entity. So that is a going concern. It's its own thing. Because then you can also sell that entity, take your business out of there when you expand, put someone else in there. It's its own business. And then you have your business, paint manufacturer, shoe manufacturer, supplier, logistics, whatever it is. This is a separate thing.
Yes.
You can also sell your business and keep your property business.
Yes.
It's always better to keep these two apart. Yeah.
Okay, I want to paint a picture. So there is Financial Fitness Bunnies, which is a PTY Ltd. We do content. We now need to buy a space to create a studio so that we can shoot from there. So we buy a warehouse. So you're saying don't buy the warehouse under Financial Fitness Bunnies. You create a separate entity. You buy the studio. Then this company, Financial Fitness Bunny, must pay rent to the property company.
Correct.
I like that. That's clever. Yeah. That's very, very clever.
Keep your things separate. Yeah.
And I always have a tenant.
You can also bring in a partner over here, and you don't have to bring in a partner over here. Or you can bring in a partner over here and not over here. So keep the things separate. They're very different businesses. Yeah.
Okay, that's quite interesting. But I think also one of the big things that, and I guess we've started tapping into some of the conversations in terms of what commercial property opportunities are out there. Now, when I went to the Galeti auction, it was like the biggest shock of my life, because there were petrol stations, there were blocks of flats, there were residential. But talk to me about what are some of the opportunities that do exist in that space.
Sure. Yeah. So typically you've got the different sectors, right? So you've got hospitality, which is hotels and lodges and Airbnbs and that kind of thing. That's one sector. You've got energy, which is petrol stations and related activities, depots and that type of thing.
People buy those things? It's like real people that buy depots?
Big time. Depot,
really?
Get the trucks in there, fill them in, store the fuel. You can even have a fuel depot and then run a whole lot of wholesale business where the trucks fill up and that kind of thing. So it's quite an interesting space. But usually in that space, the owners of the property are quite close to the actual operations of the business.
Oh, the actual,
usually.
Okay.
Not always, but usually. That's the other one. And then, of course, there's office, retail, industrial.
Just hold on, before you move it to office, retail, and industrial. When you're buying in the energy space, when you're buying, for instance, a fuel station, do you also buy the land? Like, how does it work? Is the land attached to the property?
There's so many different structures. It's actually got an interesting space. So you can buy the land and have literally nothing on it, just the license. And someone else will come and build everything, the tanks, everything, and they will run an operation. And then out of that operation, they will give you a margin on
the land,
on how much fuel they pump.
Okay.
That's how you structure it. So people always say, "What's it pumping?" You know.
Yes.
So 300,000 liters is kind of the break even, as it were. That's like a good business.
Yes.
And then it goes up. You've got 700,000. You know, like you've got guys pumping a lot of literage, and basically you get a margin on that, or you can just arrange a rental. There are lots of different structures there. So we've got a division here that actually focuses on that. So the different structures and the different methodologies and investments, and they know where they are all around the country. Then there's obviously office, industrial, retail. These are the obvious ones. Shopping centers, small, large. You know, they're different players in the different sectors. Shopping centers are like 1,300 in the country. They range from 1,000. They range from 500 square meters, the little retail one that you see, and then they go all the way up to 80, 100, 120, 135,000 square meters. So these things are enormous, you know.
Yeah. And
obviously in the bigger cap space, you've got the funds playing, the listed guys, and then the smaller cap guys. So you've got everyone. You know? And then industrial's been the darling because everything is going logistics, retail. There's a sense that retail is going to take some pain, and globally it has because you can just order online. However, in South Africa, we have a culture of going to the shops. In Johannesburg, we have a culture of going to the shop. In Cape Town, people are probably going to order online. So that's what it is. So I think some of the retail is going to take some pain. Industrial's been great because everyone wants logistics now and the new style of building with far less columns, and far more efficient, higher roofs, all that kind of thing.
Absolutely.
And then offices have got destroyed in COVID because everyone started working from home. And you find different businesses going back and different businesses staying working at home. So if you've got typically what happens is the kind of lowest tier of the company, or the guys, just general staff, they were back immediately because they can't stand sitting at home, like staying in an apartment, whatever it is. The senior executive also back quickly because they want to keep the culture of the business and all the rest of it. But the middle management and the middle earners, they are trying to stay at home because they've probably got quite a nice home.
Yeah.
They now don't have anyone looking over their shoulders. So this is the story.
Yeah.
The other thing is you get the different types of industries. So the creatives and the IT guys, they probably want to stay at home because they're not at home. They work at night. They do different things. They're in a different space.
Yeah.
And but the deal makers and the banks and the people who are client facing, they're all back typically at the.
And there's a trend of turning office spaces into residential blocks now. So how did that shift happen?
Well, basically, there were so many offices and people were desperate to get rid of them. So basically what happened is there was such an oversupply of offices because now everyone was reducing the footprint of what they required. Yeah. And so you get a net surplus in the market. Now you can't find a tenant. You don't know what to do with the space. And ultimately, you've got to sell it for a rock bottom price. People say, well, a good idea would be to turn this into residential. And so they do. It was just an opportunity that existed in the market in a period of time.
And if you're doing that, you would need to go through rezoning the space, pumping a lot of more money to try and make it into residential, bathrooms, adding all those things. Is it not a costly exercise?
Oh, it's huge. You've got to get that at sort of, in Johannesburg, you'd be getting in a really good area. You're going to be getting in sort of 5,000-6,000 Rand a square meter, which is really low when you consider that a couple of years ago, the premium spaces were selling at 45,000 Rand a square meter. So same premium space is now selling at 25,000 Rand a square meter, and so it just tumbles. So to get it for 5,000 Rand a square meter, which bearing in mind is what industrial was selling for, and now industrial's gone the other way. Now industrial you can't get for, 5,000 Rand a square meter for industrial is a bargain, mainly because the steel prices have gone ballistic, so it's really expensive to build. So it's just, the whole market's changed. Industrial is now more expensive than office property in Sandton.
Yeah. That's crazy. And I guess that's where the demand is. So it makes absolute sense. Now, off air, we spoke about a funding / investment strategy. You talked about having a carrier. Can you just take us through that?
Yeah. So if you find a great opportunity, let's say you go and find a retail center, you're a creative person, you say, you know what we're going to do? We're going to knock down this piece. We're going to create a courtyard. All the rentals at this moment are really low and they're bad tenants. But we can renovate this property, and I think we're going to spend R1 million, 2 million rand. We can get the property for 10 million rand. So we're all in for 12 million rand, and we can re-tenant this thing. And suddenly the tenants are going to go from paying 40 rand a square meter to paying 120 rand a square meter, right? Maybe a little bit less GLA, but you create a great investment opportunity. And what you see is that the value of the property is going to go way past 12 million rand. It's going to shoot to 18 million rand. Now you've got an idea, you've got a concept, but you need the money.
Yes.
So what you would do is then go and approach an investor, maybe someone in the area who also understands the opportunity. You would put in an offer to purchase with a due diligence period in it. And in that period, you say to that investor, listen, I've optioned this property.
Okay.
I have a concept. I've costed it. I've done everything. I need money.
Yes.
You then create an entity where, let's say you have 20% of that entity and the investor has 80%. He will lend money in at a return to himself. And then what comes out of that property is, and then you're going to borrow the rest from the bank.
Yeah.
And what's going to come out of that property ultimately is a far higher value property, and it's going to earn returns, or you can sell it for a higher number or whatever it might be. And then after he's paid back and after the bank's paid back, you then split it in an 80-20 ratio. And that's how you get into property. You've got a funder or a backer.
Yeah.
And they call it getting a carry. So you get a carry into that mechanism. Usually you'd have to put your 20% in, but he's put it in for you at an interest rate. Yeah.
Would it be the same if you are not necessarily lending from him, but you're raising capital through giving him equity?
Yeah, exactly. Yeah, he's loaning debt capital in,
Yeah.
And you're getting equity. He's getting equity in the business, and but you're putting in sweat equity. You're creating the equity. in this
Yes.
Same thing.
I think let's talk a little bit about return on investment. Look, you spoke about yields. You spoke about, I just want to get a better picture in terms of what can one really expect in terms of a return on investment, and what is the capex rate in South Africa?
Yeah. So just to describe what return is, right?
Yes.
So you got to look at total return. Total return is the sum of your income return or your capex or yield or whatever it is, and the capital appreciation of that project. Okay. So you add the two together, and then you've got your total return on that project for a period, whatever it might be. So if you are doing a project which doesn't have any income, then you got to look at what the return on or what the capital appreciation is going to be. So let's say you renovate, or you're doing something, you buy it and you sell it. That's a capital return.
Yeah.
If you buy a property and then you typically this happens in retail, but you get in there, you improve the tenant mix, you do some light upgrades, that property is going to be worth more as a result of the tenants now paying more, and you're having better tenants, more, less vacancy, it turns a better center. Now the rentals, not only the rentals go up, but also the vacancy goes down. You get a capital return and you have yield coming in at the same time. So it's a balancing thing. Typically when you see a low capital appreciation, you're going to have a higher yield. Okay? You don't think that the rentals are going to jump from 30 to 40 or 50 or whatever it is. You just think they're going to stay in that kind of range.
Yeah.
So therefore you need to have some kind of actual yield on that property. The yield's going to be higher. So you'll buy the property for cheaper, and you'll keep the same rental, but it's going to be a higher yield.
Yes,
so that's an example of a B grade property or whatever it is. Sometimes you think, geez, I'm buying this really low rentals. Those rentals are going to double. And then you're happy to pay more for the property on the basis the rentals are going to double, your capital is going to.
Yeah.
And so it's just a balancing act, right? So what's the right number? People always look at, they want to get, they talk about an IRR. An IRR is how much money do I put out? What are my returns over the period? And then when I sell it at the end, what's my number going to be? So people are always chasing like a 20% IRR in property, over time. But effectively, when you look at a yield, and the difference between a yield and a capex, being technical now, is a capex of what you state in the market. You say, what's the cap rate, at least, not capex. So if you say, what's the cap rate for that property? It's a 5-year property. It's got a decent tenants in this area. You say the cap rate for that property should be 10%. It's a quoted market norm. Yield, on the other hand, is derived. When you actually buy the property and you take the value of the property and you divide the net income by the value, you get a yield. And so the yield might be 9.12, whereas the cap rate that you quoted is you should be buying that property at 9 or 9.25. That's the quoted. So it depends on the property. If you're buying a AAA grade property with a bank as a tenant and a 10-year lease, or it's a nice logistics property or whatever it is, you can probably pay 9% and maybe just a little bit under 9 now, 8.75, 9, around that level. Once it starts going to a shorter lease, maybe not as bulletproof a tenant, or maybe the property is not a P grade property, then you start moving upwards, 10s, 11s. If it starts going B, C grade property with a short-term lease, 14s, 15s, and so it carries on going. So it's just a bit of a balancing act. There are external and internal factors that determine your yield, and it's all just market knowledge. So you got to go and find a good broker or a good mentor or a good co-partner or whatever it is. They'll guide you as to the process. Yeah.
And when you're buying residential property, a lot of people struggle to understand that they are in a business, especially if they're buying it for investment purposes.
Yeah.
How important is it to see your commercial property as an investment?
It's the only way to.
There's no other way.
You can't get attached to your investments.
Yeah.
You must know how you're going to exit that property. What's plan B? When you go in, you make your money when you buy property, not by holding the property. You make it when you buy. You get a good value, and you make sure you know how to exit in the case of something going wrong. What are you going to do to get out of this thing? Once you know those two things, you buy the property. If you don't know how you're going to get out of it, don't buy it.
That's so cool
attached.
because when you buy residential property, people don't buy it with the mind of location, buy for selling and whatever. So you're saying when you say that again, when you
make your money when you buy because you must buy it at the right value because then everything is upside from there. If you buy too high, then you'll never make your money because it'll never play into the value, right? So make your money when you buy. And when you buy, you must know how you're going to exit. So what's your plan B? The tenant goes bang. What you going to do now?
Yes.
Who are you going to fill it with? How are you going to sell this property? What's your mechanism? What's your exit? What is your strategy? And if you know that, you're always in a good position. People buy properties, they have no idea how they're going to sell the thing.
Of course not. They're just like, do you know how important it is for some people, a group of people in this country to just own something, you know? So I think a lot of people do that where they buy just with this idea that I own this thing.
Yeah.
But it makes no mathematical sense, no financial sense.
Don't get attached.
Yeah, I think there's a lot of attachment.
One of my mentors always said to me, I said, this property, I don't buy, my own home.
Yeah.
I don't buy this thing, it's the bad return. He says, sometimes the return is your lifestyle and your life. So you must also, when you buy your own home, it's not an investment. It's your lifestyle, it's your life, it's your family, it's where your kids are going to grow up, all the rest of it. That's how you buy your residential property. You can probably overspend all the rest and invest in your lifestyle.
Yes.
But if you buy something that's not your home, make sure you do not love it. Put love into it, but don't love it.
That is so clever. That's actually the best advice I've ever heard in terms of buying property. And I think from a more residential side of things, because I'm looking at one of my chapters in my book is I hate my house because I really think I bought it with this idea that, oh my gosh, I love this house.
It's a romance. It's a romance, right?
Goodness. This is not it. I have never swam in that pool. I have a pool. I've been there for 6 years. I've probably been in there 3 times. And it just makes no sense to me. So I think we can segue straight into looking at some tips and tricks of becoming a successful commercial property investor. But before we get into that, I want to take you back all those years ago. First deal. What was it? What did it look like? And what was the best advice you got?
First deal, Blackheath, owned by the late Vivian Slade. He had an entity called Indie Sue, and he owned this series of little warehouses, whatever. It was like 330 square meters lease 1 year. And I still remember at that point in time, I worked for this business, and the head accountant or FD or whatever is an old guy, Mr. Rabinovitz, and he insisted that when you got paid, you come and collect your check from his office.
Oh, nice.
So you had to then go to his office, get the check.
And there's a whole talk.
Well done, my boy. And then you had to run down to Nedbank and go and cash the thing. And if you banked with Nedbank, and when I was with FNB, they would actually clear it immediately. So obviously all of us changed our bank accounts to Nedbank immediately, and then you could go cash your check and you get your money. I remember it was 3,850 rand was my first commission check, of which I got half, so 1,750 rand.
Oh wow!
Tiny little deal, but it was it got me really excited and to get into the industry. So
and what was the best advice that you ever got around just deal making?
Be willing to walk away from the deal. You don't have anything until you're willing to lose it. And that stands for everything in life, I think. If you're so desperate to have the deal or to do something or to get into this relationship or have this person as a friend or work for if you're so desperate, then you don't do things on your own terms. So you should be willing to lose it. And that's the best sort of energy to hold when doing a deal. Want to do it, act professionally, push, find solutions, keep pivoting through every type of solution you can find to get the deal done, but be willing to walk away. And I've seen some of the best deals done. Some of the investors that's my last deal, and then it drops, we recently sold Langa shopping center, right?
Oh.
And it was the same thing where the seller didn't want to contract, and eventually they said, okay, we'll take that deal and move on. And it was a really good deal for them, and it was a good deal for the purchaser. And so you've got to wait till it's a right deal for you. Don't just chase. Don't just chase. Yeah. That's some of the best advice. Yeah.
That's cool. So let's go to those tips. What are some of your best tips for somebody who really wants to do well in commercial property investment?
Look, for me, starting as a broker is a great one, right?
Okay.
Because you get to learn lots of different asset classes. You get to meet lots of different people in the industry where you actually now will build up clients and friends and people who will back you going forward. So a lot of the biggest investors in the market all started as brokers. So it's a great spot to get in, and it can also be very lucrative if you're good. Then you've got to work hard, understand your market, understand the properties, who plays in that environment.
Yeah.
My partner in this business actually has a lot of residential property in Cape Town. He knows everything that's going on. He understands every agent in that area.
It's amazing.
He speaks to them every single day. Take them out for lunch, understand what's going, what's selling, be the first there, be the first to understand what stock's coming on, and then really research what the value of that stock is. If something comes on and the rental's at 50 Rand a square meter, is that market? Is that under market? Is that over market?
Yeah.
And what's the correct pricing for that? And then don't just be willing to lose the deal. If it's too expensive, don't buy it. And just go in on your terms and chase the market.
You spoke a lot about mentorship.
Yeah.
Why is that important?
For me, I've just had such great people in my life that have just guided me into certain decisions. Moving to Johannesburg, for example, John Ledley said, listen, Cape Town's a great area from the time that you're 18 to 45. That's in 4 years' time. So he said it's just a great area. You go to Johannesburg to cut your teeth. It's far harder business there. People are business focused. They're not sitting on the beach.
Yeah.
Great advice. Another one of my clients said, there are no grey areas in property. It's all black and white. You need to understand the parameters of what's happening in front of you. You need to bite off more than you can chew and chew like hell to get through it. You need to simplify things. Give me 3 reasons I should buy this property and not 1,000 reasons. Don't get too technical. Don't overanalyze things. Just simplify what you're doing and move forward. So even our of this company, simplicity in real estate comes from those lessons. And over time, just these lessons and ways of thinking, the people that have walked the path ahead of you, they help you by giving you that information, and it just changed the way of thinking. So I read a lot. I listen a lot. I've got a lot of great sort of mentors that I chat to about difficult decisions that I have ahead of me, whether it's a leadership thing, because leadership can be, it's one of those positions that is a lonely position,
Absolutely.
You can't talk to everyone in your business about the hard decision that you have to make. So you need people outside of your business that you can, ping and see
bounce ideas.
Bounce ideas. Right. So for me, it's just been so invaluable to have those people around me. Even my friends, I've got, brilliant friends who've been very successful in their individual careers and lots of different, marketing and video and hedge funds and trading and so many different things, and just sharing where we are and what everyone's going through has just been a great way to pave a career and help my way of thinking. Yeah.
Do you have kids?
One, yeah.
You have one kid?
Yeah, turning 5 in Jan, little girl, yeah.
Oh, what's the best advice that you would give about life in general?
Wow, if I was talking to her or if I was talking to someone raising a child, I think...
Or is it different when you're talking to her? Love it.
I love to let her work things out herself.
Yeah.
I can remember right from the time she was very young, I always let her work things out. I didn't just jump in and help her to navigate around an object or to understand something.
Yeah.
I would keep asking, and as a result, I think she's developed really well. I think she has, but everyone loves their kids, and then I think just in general, have fun. I think especially in our business, I tell everyone, just have fun. If you're having fun doing this, it's going to be a beautiful life. And so that's something that I hold close to myself. I like to have fun, and I like to do it with people that I love working with.
All right, John, we've come to the end of our conversation, but I really cannot let you go. I mean, you are the CEO after all. I'd like to know, what can we look forward to from Galetti Corporate Real Estate?
Yeah, so we've got a big sort of expansion plan for the business. We've spent a lot of time investing in the technology that sort of runs this business. It tracks markets connected to the deeds office. It's just a really great system, So we've spent a lot of time there. So more development and direction in that system. We'll probably move out to market as opposed to having it just as an internal system. So that's a big thing for us. And then we're just going to sort of build up our service line. So the focus at the moment is we've got auction, which we're putting a lot of attention into. Corporate services is focusing deeply on the different sectors, and then our broking team is going to grow quite a bit over the next sort of year period. So once that reaches a level where we're comfortable with it, it's reached that sort of settling period, then we're going to start looking at other service lines in the industry, and I think that's where we're going to go, and we're going to use our tech as a wrap and on all the IP that pulls into this business, and that's really our main focus for the business. So a lot of building to be done.
I like that. What did they say? Big data, big business. And I guess with the tech move, that's what you guys are ultimately trying to do.
Big time.
Very exciting. I went to your auction and I was really excited. And I'm thinking, you know what? We need to get somebody in this room to come and talk to us about the auction process. So guys, do look out for that video.
I loved what you said about it. You got there and you were, this is a secret club or
something. Listen, it felt like a secret club. Guys, I walked in there and I'm like, who are these people? Why do we not know what's happening here? And I'm really, really excited to really uncover some of those processes that go into auctions. And I think we're going to be speaking to some of you guys about it. But you've been absolutely fantastic. I can never thank you enough for the time you've taken today to really just give us a key.
It's been great.
You know what I mean? And I think there's a lot of things that we all think we know, and then you realize you don't know enough, and then you realize, okay, but there are people out there that have this information, so we're really, really grateful.
And you asked me some interesting questions. You made me think there for a second.
I'm glad to hear that. But thank you very much once again, and guys, thank you very much for tuning in. I will see you guys on the next one.